Hello everyone, thanks for checking out my video. S&P 500 and Nasdaq snapped their losing streak last week. The US stock market is a little erratic right now. Nvidia had a blowout quarter, yet it was only up 0.1% post-earnings, and many other AI tech stocks faded one day after Nvidia reported its earnings. Then, on Friday, when Powell seemed to appear hawkish in his speech, many stocks rebounded. But interestingly, Nvidia was down 2.4%. So, if the AI leader is struggling, what chance do other growth and AI stocks have in terms of continuing 2023's rally, which has been led by AI? And for option traders, I have a tip for you in this video, so do watch on as we dissect some of these things in this video. The stock market started last week on a strong note, but then tumbled on Thursday after Nvidia's solid earnings. Strange, right? But it recovered a little on Friday after Powell gave his speech at the annual Jackson Hole Symposium. With regard to Powell's speech, some say he was a little hawkish, while others find that he was actually neutral, and investors gain optimism from the strong and resilient economy that Powell has mentioned. Anyway, it's up to how an individual wants to interpret his speech. Nevertheless, here's a quick summary of what Powell has shared. Basically, while he acknowledged that progress has been made in the fight against inflation, Powell said inflation remains too high and is still above their target of 2%. He also warned that they are prepared to raise rates further. So this is the hawkish part. However, he further mentioned that a strong economy and decelerating inflation do give the Federal Reserve room to proceed carefully at upcoming meetings. Finally, Powell acknowledged that the risks are two-sided, with dangers of doing both too much and too little. So, in summary, he basically didn't give any clear direction of the next rate hike. Maybe, just maybe, since there is no surprise from him, the market likes it and the market rallied on Friday. Meanwhile, Nvidia reported their earnings last week and it was spectacular. The earnings can be summarized in 3 points. First, they beat market expectations with its Q2 results, and then they surprised the analysts by giving a forecast that exceeded expectations by billions of dollars. Finally, they announced a shares buyback plan of $25 billion. But interestingly, the stock was flat one day post-earnings and down 2.4% the day after. I think the one takeaway from this is that don't be too fixated with a certain outcome. This is one best example. Nvidia beat earnings and forecasts on all fronts, yet the stock declined. It's a classic buy the rumor, sell the news scenario, and also a classic example of how an overextended stock can pull back despite positive news. In terms of market outlook, if you don't already know, we are about to enter one of the most bearish months of the year, and that is none other than September. On average, September is the month when the US stock market's 3 leading indices usually perform the poorest. Some have called this the September effect. If you check out the chart on the right, you can see that September is the only month in the past 50 years in which the S&P 500 gave a negative average return at negative 0.8%. This chart is put from Capital.com, so credit goes to them. On their website, they also shared that the economic cycle seasonality could be the reason why stock markets fall in September. Basically, September is traditionally a slow month for retail sales in the United States, as consumers usually cut back on their discretionary spending and increase the amount of savings at the end of the summer. I don't know how true is this, but yeah, I got this info from Capital.com. Okay, let's now move on to the technical analysis section. First of all, when we zoom out of the SPY chart, it appears that a bearish head and shoulder pattern is forming. If this plays out, I think we can expect SPY to hit that bottom of the uptrend channel in September. So how do we gauge or look out for confirmation on whether will this pattern play out? First of all, pay attention to the neckline. That's the most important support line in a head and shoulder pattern. I would say it's around 433, with maybe a bit of buffer at 430. So if SPY breaks below 430 to 433 area, bulls have to be very careful because bearish momentum is seeping in. And if the 38.2 Fibonacci level of 428 gets breached, I would say there is a very high probability we will hit that bottom green dotted line of this uptrend channel. From here, I wouldn't be surprised if we continue to head towards the gap at 421 to 422. At this area, with a bit of buffer, say maybe 418, SPY should hold if this bull market is still intact. So yep, hope you got it. Watch out for the neckline this and next week. If it breaks, SPY is turning very bearish and I wouldn't go long until it bounces up again. On the other hand, the head and shoulder pattern will be invalidated if SPY closes above the 50 moving average with about 2 or 3 candles. That will then bring SPY above 445 and way above the downtrend channel marked by the 2 blue dotted lines. Speaking of this channel, SPY broke out of it last week and did a classic retest of the channel and remains above or outside of it. That's bullish, so look for confirmation this week. If by midweek we are still above this channel, it means SPY still has bullish momentum and could retest the resistance level of 440. Anyway, if SPY starts closing above 440 and the 50 moving average of 445, I would say SPY is quite bullish and may then charge towards the gap at 453 to 455. But around this area, with some buffer to the top end of the uptrend channel, which is around 460, SPY should face some resistance. If it breaks free from here, I will not bet against SPY because it will likely charge towards a new all-time high. Moving over to Apple. Apple has stopped its rot since post-earnings where it plummeted from 190's range to as low as 172. One small bullish signal is that the MACD has started to cross up. But whether it can continue to go up, here's what to look out for this week. Come this week, watch the support level of 177. As long as Apple stays above this level, we have a chance to test the next resistance level at around 181. In fact, Apple tested twice last week and got rejected. I do think we will likely test it again this week. If Apple punches through this level, the MACD will definitely continue to go up, and that is very bullish. By doing so, it will also give us a decent probability to charge towards the heavier resistance at around 185 to 186, where the next Fibonacci level and 50 moving average are. I know there is a big gap at the top, which is between 187 to 190. Personally, I think it's quite tough for Apple to fill it or break above it. But if I am wrong and Apple closes above this area, it's super bullish. In terms of the downside, as shared earlier, 177 continues to provide a decent support. In fact, it's quite a critical one. Apple actually got lucky when it broke below it previously and managed to recover. But if it goes below again, I would be cautious to go long because of that gap between 166 and 170 below. It may act as a magnet to pull it down further. The bottom of the gap, which is around 166, actually coincides with this long-term downtrend line, so it should act as a strong support. That was actually the reason why I saw a cash secure put with a strike price of 165 when Apple plummeted. And so far the trade is doing great. So maybe this could be an area for consideration if you wish to sell a cash secure put. Not financial advice, okay? Alright, let's now check out Tesla's chart. Something rare to share with the viewers. Can you see these 3 candlesticks? This looks like a bullish abandoned baby pattern to me. Quite interesting, right? The name of this pattern. It may not be a carbon copy or textbook version of bullish abandoned baby pattern, but it does look like one to me, with a first large red candle, followed by a doji light candle that gaps below the first candle, and then the next candle opens with a gap up above the doji candle and moves aggressively to the upside. The next 2 candlesticks that follow after actually gave us some sort of confirmation that it is short-term bullish as they started to test the upper end of the downtrend channel. In fact, I tried to sell a cash secure put here, which is a bullish move, but sadly my order didn't get filled as I wanted a higher premium. And after that, Tesla continued to hug the upper channel line and has slightly broken out of it as of last Friday. If it breaks out of it convincingly, I may look at selling a cash secure put this week. But just a word of caution, out of this channel, we actually have a strong resistance coming in at around 240 to 243 area, which is formed by the Ichimoku cloud and the 38.2 Fibonacci level. A break above this area is quite bullish for Tesla and may just bring us to 250's range. Just one more thing to note, the MACD seems to be wanting to corrupt, and this week's movement will give us the indication whether it can have a bullish cross or not. Alright, before I talk about the downside, I would like to call for your support for this channel again. You can support me at no cost by simply tapping on the like and subscribe buttons, as simple as that. And I hope that I can grow this channel to 1000 subscribers as soon as possible. Just about 160 more subscribers to go. Do share my videos with your friends if you found my content useful. And other ways of supporting the channel include signing up for some of the services using my referral links below. It can be for Weibo, Tiger, Utrip, Shopback, etc. And if it's within your financial means, you may consider buying me a coffee at $4 via my Ko-fi page. Thank you. Okay, in terms of the downside for Tesla, the first support level is 225. In my view, this is a weak support. A stronger support will only coming at around 208 area where the 61.8 Fibonacci retracement level coincides with the bottom end of the downtrend channel. If we break below this level, then the next strong support is the 200 moving average at 197. Maybe give and take a little bit. I would say 197 to 200 area would be a decent support. A break below this will likely see Tesla waterfall down because there isn't much support till 160's range. Okay, finally let's now move over to Google. In my last two videos, I have shared that Google has been consolidating for a while already. So last week, it attempted to break free from this consolidation zone but failed to do so, and ended the week back in this tight range of about 127 to 134. That's about 23 days or one full month of consolidation. And if you had followed my videos long enough, you will know that I have shared on many occasions that the longer a stock consolidates, the more the Bollinger Band will squeeze. When that happens, it is usually followed by a big move, though not all the time. And sadly, it is almost not possible for me to predict the big move, is it up or down. Anyway, by zooming out the chart, you will be able to see that this has been quite common for Google, where it's consolidated for a while and what followed after was a big move. So now as the B-band gets squeezed, investors and traders need to be mentally prepared for a potential big move. In terms of the downside, there is a strong support at 127. As you can see, every time this level gets tested, Google bounces up. But it is noteworthy to highlight that there is a bearish divergence on the RSI. So if this bearish divergence plays out and 127 breaks, I would say there is a high probability for us to fill that gap entirely, which is between 123 to 126. If the so-called big move is really on the downside, we may also test the 61.8 Fibonacci retracement level. This is a critical level. But if you want to have more buffer, 120 is the last line of defense in my opinion. If that breaks, we have very little support below. Okay, in terms of the upside, it's quite straightforward. Google needs to break free from 134-135 area. That will then bring us up towards the gap between 139 to 140. When this happens, it means this 2023 uptrend for Google is very much intact and it may just chop around and consolidate around this area again before the next huge movement. Again, consolidation is good for option sellers, so you know what to do, huh? Let's now move over to the options trading segment. So last Friday, I had two options that expire. The first one is this cash secure put on Tesla with a strike price of 220, expiration date on 25th August. Do you recall I shared about this trade in my last video? A quick recap, this trade was down 200% and as of the closing bell on last Friday, the contract expired worthless, which means it was up 100% and that's a 300% swing. So yep, there is no hiding or anything. I was transparent when the trade was very red and I am glad that you got to witness how this trade has swung from deep red to 100% green. In fact, this is not the wildest swing that we have witnessed. The craziest swing was about 1000%. You can check out the video link at the top if you are curious to find out more. The next contract that expired worthless was this cash secured put on Google with a strike price of 113. This put was sold on 18 July. The reason why I entered this trade was because Google has broken out of this purple downtrend channel, so that was bullish. Then it retraced back to do a classic textbook retest of the downtrend channel and bounce up. That's even more bullish. Therefore, the moment it bounced up, I know this contract will likely expire worthless. And true enough, Google gapped up soon after and never went close to my strike price of 113 ever since. The third trade to update for this week is this new trade that I have made on 25th August Friday. It's a cash secure put that I have sold on Google with a strike price of 118 expiring 29 September. And within half a day of opening this trade, the trade is already up by 33%. Anyway, the reason why I sold it is because Google is in this consolidation phase. So the longer it consolidates, the better it is for option sellers like me, which I have shared before. Also, to highlight, I realized this 126 and 127 areas seem to be quite a decent support. Even if this breaks, Google has multiple support levels below, with the key ones at around 122 and 120. But remember earlier I mentioned that the Bollinger Band is squeezing and a huge movement could be coming? As I cannot predict whether the next movement is up or down, I decided to play it safe by choosing a strike price that is below both 122 and 120 at around 118 to give myself more buffer. Basically, for my contract to be assigned, a lot of things must happen. First, the big move must come soon. Second, the big move has to be on the downside. Third, it has to break 3 key support levels at 127, 122 and 120. Anyway, I would like to share a tip for consideration, but not financial advice, okay? Sorry, before I move on, if you are keen to check out the Excel sheet that I use to track my option trades, you can download it for free on my Ko-fi page. And for those who are interested in my real trades from 2022, you can consider buying it from my Ko-fi page as well at $4. In the file, you will be able to see the stocks that I have traded, their days to expiration, strike prices, whether the trades expire, close or wrote, etc. I thought they could be useful for some of you. Okay, anyway, here's something for consideration, and that is to sell cash secure puts in September at key support levels with expiration dates in October. So if this year is not any different from the previous years, then the stocks that you sell cash secure puts in September will likely recover in October, and your contracts could likely expire worthless. But of course, there are lots of caveats or nuances here, such as the stocks that you pick, the strike prices, days to expiration, etc. All these do matter. Well, I am sorry that I can't go so in-depth to offer very precise trade recommendations, and I hope you would understand. Once again, I must emphasize that this is not a financial advice, but it is something that I am planning to do. Also, please have a backup plan if things go south. Alright, as usual, some end thoughts to wrap up the video. We just saw 2 key events concluded last week. With Nvidia's spectacular earnings and an unsurprising speech from Powell, the market should have gotten what they want to end the recent pullback. As both events happened towards the end of last week, I would say this week would probably be the week to set the tone and direction for the month of September. Will we finally have a positive September or a less bearish September? Let's see. Personally, what I don't like right now is that the 10-year Treasury yield is floating around its 16-year high. Again, if you don't already know, typically stocks fall when bond yield rises. It's quite a simple theory. Bonds are deemed as less risky assets and it is backed by the government. So if it can give investors an almost guaranteed 4 to 5% return, why would investors want to invest in the stock market that is so volatile with returns that are uncertain? Therefore, I would say for the first time in a long time, stocks actually have some real competition as investors may want to shift their money from the stock market to put in the bonds. Overall, I would say the stock market is at this cross junction as we enter September. Firstly, as shared earlier, the latest 2 key catalysts or events have not sprung any surprise on the stock market, so theoretically, it should put an end to any talks on correction or a crash. But then again, September somehow has been a sluggish and bearish month, so which way will the market choose to go? Honestly, no one can be super sure. All I can say right now is, despite the pullbacks we had in the last few weeks, there is no need to panic yet. And even if September continues to be the month of pullbacks and retracements, it should not cause much concern. unless of course key support levels of the indices are breached. Otherwise, I would call this a pullback in a bull market, and this means two opportunities in my view. One is to pick up shares, which I did in the first half of August, and second, it is to sell cash secured put options because the probability of your strike prices getting breached is lower than say other months. Alright, that's all for this video. How are you planning to navigate this potential bearish month of September? Let me know in the comment section below. Do help me grow the channel by tapping on the like and subscribe buttons. Thank you.